Okay, should I go ahead and get started?
Yes, please.
All righty. Excellent. Let me go ahead and hide this guy. All right, so you can see my PowerPoint up right now.
Yes.
All right, excellent. All right, welcome back, everybody. And thank you for making the time again. For anyone I have not met, my name is James Knape, and I'm a CPA, and I lead North American partnerships here at Summ. For those that don't know, we're a crypto tax and accounting platform used in over 180 countries and by thousands of accounting firms. We're also partnered with some of the large exchanges in the world. So, digital asset tax is the world I live in, and it's pretty much the ecosystem I live in every day. So, yesterday, for those who were there, we built the foundation. Essentially, what's taxable, capital versus ordinary income, the whole mental model for how the IRS treats crypto. Today, we're going to go more narrow and deep on the one development that has changed the filing era more than anything else, and that's referred to as the 1099 DA. So, after that first April 15th busy season, if you've been hearing that term, nodding along in meetings and quietly hoping nobody asks you to explain it, this is the hour that'll fix it for good. So, what we're going to cover for these next 50 minutes, and by 2 o'clock, you'll be able to pick up a 1099 DA, read it line by line without flinching, be able to spot the errors that are going to be all over these forms in year one, and most importantly, reconcile what the broker reported against what your client's records actually say. From there, you'll be able to interpret it, catch the mistakes, tie it to the truth. That's essentially your entire job as a practitioner, and it's very learnable. So let's go ahead and take it apart. So, quick 30-second orientation here so you know where we are. This is the middle of 3 sessions that build on each other. Yesterday was foundational, so the baseline every holder and every preparer needs, no matter the complexity of the situation. Today's the 1099 DA, and it's given its full hour because, frankly, it deserves one. And then tomorrow, I'll walk through the compliance workflow, start to finish, and literally run from the raw transactions that sit in a wallet all the way to the finished numbers on the return. So today stands completely on its own. You don't need yesterday to get the full value out of this hour, but I will re-anchor everything you need as we go. But here's the one sentence from yesterday that everything today hangs off of. Crypto is property, and disposing of it, which includes selling, swapping, or spending, is the taxable moment. So throughout the presentation, just hold that single idea, and the 1099 will stop being intimidating and start becoming second nature to you. So with that said, let's get into it. So I'm going to tell you exactly what you'll walk out being able to do. And today we have 3 concrete goals, and they map directly onto the first 3 things that this form demands of you. The first is you'll be able to interpret a 1099 DA. So when one lands on your desk, you'll know what every meaningful box means, which numbers you could actually lean on, and which ones you have to treat with a raised eyebrow. So there's going to be no more squinting at an unfamiliar form, wondering what half the fields are trying to tell you. Second pillar here is you're going to be able to spot common errors. And I promise you, by nature of the forms and the systems, there will be errors. This is the first year these forms exist at any scales, and the brokers are building the plumbing as they fly. Data quality shows it. The rollout showed it. It was a rough tax year for some of the brokers. So I'm going to walk through 4 specific failure points and exactly where on the form to look for each. So you could go ahead and catch them, save your client real money, or at least save them from a notice. Third and final, you're going to be able to reconcile the form against your client's records. That is the real skill of the hour, and it's where your value as a professional and practitioner actually lives. So the 1099 DA is not an answer key. It's just one input, one data point. Your client's own complete records are the single source of truth. And I will show you precisely how to tie the 2 together and then report the difference in a way that holds up. One note before we dive in, this is foundational and practical by design. Avoided a lot of the theory for its own sake. But if you're already deep in these forms, please don't tune out. Just treat today as a clean, correct framework you could hang the messy real world cases on. And for some of the experts in the room, please make it collaborative. I generally learn from these conversations and the whole room benefits. So everything today is educational and, of course, not tax advice. Now, let's start with the why. Why does one new information return deserve a whole hour of your time? It's because for the first time in the history of crypto, in the US at least, your client's activity is being reported to the IRS directly by the exchanges. So think of it the same way a stockbroker has always reported your 1099B directly to the IRS. It's very similar. However, that one structural change quietly rewires how crypto compliance works as a whole, who holds the leverage, and most importantly for the audience, where that risk sits. So let me show you exactly what I mean here. So here's the whole shift in one picture. For years, crypto was a blind spot to the IRS. Of course, they knew the activity was happening, a couple $1 billion worth of it, but they could not see into the specifics. So they were leaning on people to self-report honestly, and we all know how common that is in this asset class. The ethos of it is people don't like to pay the tax. So they came out with the 1099 to close that blind spot permanently. Now, think about this, how this works everywhere else in your practice, because that's the key to not being intimidated. Your client's employer will send W-2, one copy to the employee, one of the Social Security, which goes to the IRS. Then your broker and the stocks will send the 1099B, one to the client, one directly to the IRS. So it's 2 copies every single time. So when that return comes in, the IRS isn't taking anyone's word for anything. What they're doing in the background is they're running a match. So the 1099 DA simply drops it into the exact same machine that's been running for decades. But let me make the consequence concrete with a number, because say the exchange reports on a 1099 DA that your client has $30,000 worth of proceeds. That figure is now sitting in the IRS system before the return is even filed. So if that return comes in and shows nothing or shows 5,000, the computer is going to automatically flag the $25,000 gap, and it flags it automatically. So there's no human deciding to look. There's no one sitting behind a desk doing this. So the number one consequence, and I do want this to really land, the return now has to agree with the form and often explain why it doesn't, because the accuracy is in question here with the rollout. Now, the reassuring flip side, especially for a room full of CPAs and attorneys, it's pretty familiar territory. You've done a reconciliation of 1099B for your entire career. So think of it in the same principle, with the 1099 being a new form and not a skill. So this is going to be the frame for the whole hour. You already know how to do this. It's just going to be nuance on the crypto side. So before we read one, let's define what it is, who has to send it, and what's actually printed on it this year versus what's going to show up next year in the 2026 tax season. So we're just going to quickly run through three quick slides to set the table, and then we'll put a real one on the screen and run through it together. In short, Form 1099 DA, the DA stands for digital assets. So it's the new information return that the brokers now filed to report your client's DA dispositions. And from yesterday, this means sells, swaps, and spends. So not just sells. The swaps and spends are often missed by the practitioner and the crypto holder themselves. So every one of these is a reportable event, and now the broker reports it for you, whether or not your client remembers it happened. Now, the timing is paramount here. The forms covering 2025 activity are the very first ones ever issued. They landed in early 2026, so this filing season. So it's no longer a someday or get ready for the future problem. Your clients receive these between February and May. And yeah, a lot of them have ignored it. So you're going to be the person they bring it to. Now, setting expectations, because it's the through line for the entire session, like any 1099, you get a copy, the IRS gets a copy. That part is normal. But unlike the system with the 1099B, that has been refined over decades, and this one is brand new. So the brokers are standing up brand new reporting systems under a brand new set of rules, which means the data quality in year one is going to be genuinely rough, and it was for a few exchanges, a few of the major ones. So the sentence I'm going to repeat until you're sick of it is treat the 1099 as a claim to be verified, not an actual fact to be copied. So if you internalize nothing from today, understand the 1099 is not the authority. It's just the record keeping the IRS has. So the question, a major pillar here, is defining who the broker is. So it's one of the questions I get more than any other, and we're going to be precise about it. So the people that identify the broker are custodial brokers. And the cleanest example to anchor on is a centralized exchange that actually holds your client's crypto for them like a bank. So think Coinbase, Kraken, Gemini, Crypto.com. It's a company that custodies the assets and actually executes the sale on the customer's behalf. That is the broker, and those are the only people that need to report to the IRS. Now, the part that trips people up and is often a blind spot is the decentralized finance, also known as a DEX, where all the DeFi activity goes on. And those front ends are not required to report because the IRS wrote a rule that would have swept them in, but Congress repealed this in April 2025 under the Congressional Review Act. And the Treasury actually pulled it right back out of the regulations. So when your client does a self-custody swap through a DeFi protocol, for those not crypto native, think Uniswap, there is no 1099 DA that they're going to report. And because it went through the Review Act, the IRS actually barred from writing a substantially similar rule again. So it will remain that way for the foreseeable future. Now, you can imagine why that's dangerous because it's the biggest trap of the new era. Your client's going to reason with this as, hey, no form showed up, so there's nothing to report. And it's completely wrong because they also think it's not traceable, and on-chain activity is the most traceable activity there is. So there's going to be no paperwork arriving in the mail to remind them, and no copies going to the IRS to flag it if they forget. So that gap between centralized trading and decentralized trading is enormous, and it's going to be a massive source of honest underreporting, and it is on the onus of the professionals to catch that on your client's behalf. So quick mental model: centralized exchange, mean a form is coming; DeFi, no form, but all of it is taxable. In the presence or absence of the 1099 DA tells you exactly one thing: whether the IRS was told. Tells you nothing about whether transactions are taxable. So if a client comes to you and says it's not taxable DeFi activity, please correct them and hold strong on it. So we're going to talk about what's actually on the form, because this is where the phase-in really matters. Year one and year two are very, very different animals. This tax season is year one. Next will be year two. And there's two numbers to track, and that's proceeds and basis. So on the proceeds side, for the 2025 activity, the forms have landed in the past few months and are continuing to land. So brokers report your client's gross proceeds to the IRS. It's the total dollar value of everything they've sold, swapped, or spent. So the first wave of forms told the IRS how much value went out the door, but it does not report the cost basis of what it originally cost, which means on its own, the form is going to show a big scary number with no offset against it, and it likely won't be accurate. So the second shoe is the basis, which drops next year. And it is broker basis reporting phases for assets acquired on or after January 1st, 2026. So on next year's forms, you're finally going to start seeing what your client paid, but only for the actual coins they bought in 2026 and held at the same broker the entire time. Now, this brings us to the single most important pair of words on the entire slide, and it's covered versus uncovered assets. So a covered asset is one that's acquired at that broker on or after the beginning of 2026 and held continuously on the same platform until they sell. So the broker is going to report the basis on that. A non-covered asset is anything bought before then or anything transferred in from any other wallet, centralized exchange, or decentralized exchange. And for those, the broker is intentionally not going to report the basis at all. Now, here's why you must care about the distinction, because for the next several years, the overwhelming majority of what you'll see is going to be non-covered, which means the blank basis box is everywhere. And it's important to understand that a blank basis box is not an error. It's actually a system working exactly as designed. So simply means the broker's number is not the broker's job to report. It is yours, either you or your client. So that reframe will save you a bunch of anxiety or confusion during the tax season when you first start seeing these. So enough describing it from a 30,000 foot view. We'll put a real one on the screen, actually go through it together box by box. And this is the interpret a 1099 DEA portion that I promise you. And I think it'll be easier than maybe what you've heard or what you've seen. So here's a portion of the 1099 DA. The truth is that only a handful of these boxes drive the actual work. And let's walk through exactly the ones that matter and ignore the rest. So up at the top here, you're going to see boxes 1A, 1B, and 1C. And all that does is just identify the asset. It's each digital asset, think Bitcoin, Ethereum, Solana, whatever, have the name of it and associated code and the number of units sold. That's simply what was disposed of and how much of it. So nothing tricky. But then come the 4 boxes that actually do the real work. And if you know your 1099B, it's going to feel similar. Box 1D is the acquisition date. Box 1E is the date sold or disposed. So those two combined actually define the holding period. Short versus long-term capital gain, which we covered yesterday and you guys already understand. So it also decides whether the gain is taxed at the ordinary rates or the preferential long-term rates. Moving on to box 1F here is the proceeds, and that's what it's sold for. And then box 1G covers the costs or other basis, which proceeds minus basis equals the gain. So it's the same logic you've applied to the stock sales your entire career. Nothing crazy there. So as you see on this 1099 DA, it shows to Ethereum in box 1C. You sold it for $8,000, proceeds in box 1F. So box 1D said it was acquired back in 2021, and box 1E shows it was sold in 2025. So instantly, you know this is a long-term holding. Now, proceeds minus that basis turns into your gain. So if box 1G shows a basis of, let's say, $3,000, it's a $5,000 long-term gain. Same 1099B math that you guys are very familiar with. But look closely at this form and you notice 1G is blank. And that blank box is the entire ball game. And it's exactly what we're going to work through on the very next slide. So the boxes that are special to this era, you're going to care about box 1G, which is very often blank. And that covers the non-covered basis gap. Box 9 is the checkbox that is literally says non-covered security. When it's checked, the broker is still telling you in writing, hey, I'm not standing behind any basis here. That's on the taxpayer or the practitioner. So box 8 tells you the broker relied on the customer provided information. That's usual flag because it means that the number on the front of your originally came from your client, not from the exchange's own books. In box 1I, the wash sale rule disallowed. You're going to see that printed there. And the short version, it's knowing worth cold. For ordinary crypto, that box will always stay empty because the wash sale rule doesn't apply to crypto, which actually creates a huge tax loss harvesting opportunity for the client. And the final box that earns a mention here because it's the whole transfer story in miniature. Box 12 captures the units transferred in and the transfer in date. So keep that one in your peripherals. It's going to be central to the reconciliation problem we're going to hit in a few minutes. So working example, we'll pull it together. Just covered in one working example because watching a single form flow through the whole process from start to finish is where it clicks. So step one here is going to be interpreting it. This form shows that your client sold to Ethereum for $8,000 worth of proceeds. That's in box 1F on September of 2025 in box 1E. And then box 1D tells you the acquisition of the Ethereum was in March 21. So right away, reading straight off the form, you know, two things. One, it's a long-term holding, and the proceeds are $8,000. Now, step two is catching the error. So take a look at box 1G, which defines the cost basis. As mentioned, it's often blank. And then box 9 is non-covered. So that tells you it's a non-covered security. It's checked. You know exactly what that means now. The Ethereum was acquired before 2026. So the broker is not required to report that basis. That's on you. And the trap we're circling, if the blank box flows under the return untouched, the basis defaults to zero, and your client's going to get the full tax bill on the $8,000 capital gain as if it were a pull gain. But if your client didn't get that Ethereum for free, say they paid $3,000 for it in 21 and you have it, it's right there for the records. It saves them money. So step three is going to be the reconciliation of the report. You're going to take the correct basis, $3,000 from your client's records, and you're going to report the sale in Form 8949 and the section where transactions where the basis wasn't reported to the IRS. So because the broker reported no basis at all, there's going to be no adjustment code to fuss with. You're just going to enter the $3,000 basis in the basis column. Then the Form 8949 then shows the proceeds of the $8,000, basis of the $3,000, and then lines out to them that it's a $5,000 long-term gain. Now, step four, take a look at what you just did and think about the two outcomes side by side. Left alone, the blank box taxes your client on the full $8,000. Once you reconcile it, the taxable gain is $5,000. So you just saved your client tax on $3,000 of basis that was sitting there in the records the entire time, purely because you gave the 1099 DA some scrutiny. And as a practitioner, really, that's the whole job into the hour, compressed into one transaction. You interpret the form, distrust the blank, perform the reconciliation to get to the truth, and then you're actually filing the 8949. So when you come across a client with crypto, you're going to do this every single time and realize that the 1099 DA doesn't carry the weight you think it does. So before we ever let ourselves trust that form, I want to touch on the transition relief because it explains something that will otherwise probably drive you insane. Why even a filled basis number might not match your client's books. So the IRS, they already know your one is very messy. They've said so in writing, and they've actually given specific relief you could cite. Two notices. Notice 2025-7 allowed their taxpayers to make the spec ID lot identification in their own books and records for 2025, rather than instructing the broker in advance because the brokers were not built to accept these instructions yet. And then notice 2026-20 extended that same relief through the end of 2026. So right now, your own client's record is perfectly valid way to identify which specific tax lots they sold. And the practical fallout here is the entire reason this slide exists. The client and taxpayer was identifying lots on their own side, while the broker was defaulting to their own method, which is usually FIFO. So picture your specific client identified a specific tax lot at the high basis, which exists to keep the gain low. The broker doesn't know that, and they assumed FIFO and reported the first in, first out. So the same sale, two different basis numbers, two different gains. So even when that box 1G has a real number sitting in it, understand that that is simply the broker's reporting version of the events, and they don't have the full picture. Now, getting tactical about where these forms break, I'm going to give you 4 failure modes. They'll account for the majority of everything you run into this year. There's always going to be fringe cases, but this should be enough to point you in the right direction and get you the same framework to approach every 1099 DA and crypto client. Now, error one is going to be that blank or zero basis. As hammered in this presentation so far, that's the most common one and the most expensive if you miss it. So box 1G, it's going to be blank because it's a non-covered asset. And your client's going to get taxed on the entire proceeds instead of their actual gain. So to make it concrete, $100,000 sale that had a $90,000 basis, obviously will produce a $10,000 gain, but uncovered, they're going to treat it as a zero basis and it's going to be taxed at the full 100,000. As you know, that's going to be a catastrophic overstatement driven by nothing but an empty box. And this would be the first one I would hunt every single time. Error two is going to be the double counted transfers. Not as common, but it is a sneaky one and it quietly overcharges. So say your client moves from Coinbase to Kraken. As recovered yesterday, not a sale. But in year one, a transfer between brokers can get misreported as a disposition because they lose visibility on it. So they don't know the cost basis that Coinbase had. They assume it to be zero. So always watch box 12 and cross-check every single transfer against your own wallet history. Error three is going to be the wrong dates and holding periods. Because of that transition relief we just walked through, the acquisition date's going to be shown in box 1D. That could be wrong because the broker defaulted to the wrong tax lot. And that date matters because it could trigger a short-term capital gain versus the appropriately treated long-term capital gain, different tax rates. Last one, most dangerous one by far is the missing form entirely. So it's the error of omission on behalf of your client. Crypto people don't like to file taxes, so they might have intentionally missed it or just not known to do it. So just remember that DeFi and self-custody do not generate the 1099 DA. So if your client was active on 5 different platforms, only 2 of them were centralized exchanges, the form gives you a dangerously incomplete picture. Only 2/5 of the story, and the 1099 presents it as the whole thing. So just recall that the absence of the form is not the absence of the transaction. Step back, treat it as that puzzle we talked about yesterday. It's your job to get the complete data set and piece together the negative space to get that full picture, which you're going to document on the 8949, the Schedule D, and Schedule 1 that we went through yesterday. So reconciliation piece. It's tying the form to the truth. It's the least fun part of the job, most time consuming, but it's where a professional separates themselves from a data entry clerk. And here's the method in 3 clean steps. So the governing principle in the single sentence I wanted to carry out of this slide, 1099 DA is one input. Your client's complete records are the source of truth. So you're not transcribing the form onto the return. You're taking that form, the 1099 DA, comparing it to your complete picture, and then reporting the reconciled results. So the hierarchy is 8949 takes precedent, 1099 DA is lower and probably not truthful, although it is what the IRS looks at. So step 1 in the reconciliation is build the complete picture, put every wallet, every exchange, not just the ones that were mailed a form. It's the puzzle I described. And then step 2 is to match that form against the complete picture. So take the 1099 DA, compare it to your own client records, and hunt for the breaks. Specifically that blank basis row we keep talking about, or the transfer that got miscounted as a sale, or the acquisition dates being inaccurate. And that brings us to step 3, which is to report the reconciled number and show your work on the 8949. So that third step has very specific mechanics and where people fumble. So for the 2025 forms in front of you, the broker didn't report any basis. So you report the sale in the basis not reported section of the form 8949 and simply entered your client's correct substantiated basis in the basis column. Now that column on the 8949 is going to be in code B, where the broker actually reported a basis to the IRS, which starts happening for the covered assets acquired in 2026 and later. and that reported figure is wrong. Then you keep their number, you flag it with code B, and you correct it in the adjustment column. So either way, supplying a blank or correcting a reported figure, the point's identical. It's the same process because the return ties to the 1099 DA that the IRS is holding, and it still reflects the truth. So your job as a practitioner is to document the difference and explain it to the IRS with that Form 8949 adjustment. Caveat here, it's nearly impossible to do by hand, which is actually why the software exists. So whether you use us or a competitor, it doesn't matter. Make sure all the wallets and exchanges are uploaded by the client. Your job to piece it together and generate that Form 8949 in whole. So a little deeper on the structural problem in all this, it's the coin moving between brokers. You have to understand that the rule is the cost base is supposed to follow it through through something called a transfer statement, and that's under section 6045A. In a fully mature system, Kraken would send Coinbase a statement saying, hey, this coin costs 8,000, acquired on so-and-so date, and the basis would simply write a line with the coin. But unfortunately, the system is not operational yet, and frankly, not that close. So when your client does do a transfer from a coin to another platform, the receiving broker typically has no idea what it costs and what it was bought for. So it does the only thing it can, and it flags that asset as non-covered, reports the blank basis, and gives your client a rather large tax bill. So zooming all the way out to the actual conversation you should be having with all your crypto clients this year, 3 things to tell them in plain language. First being, you're going to get the forms. They are incomplete. Set that expectation up front from the first meeting. 1099 is a starting point, single data point, not the final word. And the platforms didn't send a form to each other to get everything accurate. So that single reframe moves your client from, hey, the exchange already did my taxes for me, it's taken care of, to the exchange just handed me a puzzle piece, please figure it out for me. Second thing you should do is bring me everything, not just the forms. So get on a software, say, hey, I need every single wallet, every single exchange, most importantly, every year. If they started trading in 2007, those cost bases, they compound every single year. So you're going to have to perform the reconciliation from the date of their first crypto trade, full stop. Now, the third here is make sure the client answers the DA question honestly. As mentioned yesterday, it sits right at the top of the 1040, and it's assigned at a station, so you don't want to lie on it. So when your client reports the 8949 Schedule D, they're going to match it against 1099 DA. So checking no on your client's return or them checking no on their own is going to be the first trigger for that 6174 letter or CP 2000 notice that are going out right now. And they're most likely, it's going to be a wave in early 2027. So make sure the client's honest about it. Certain clients don't want to deal with it. Some don't want to pay taxes. They're under false impression it's not reportable. So just be sure to make sure that you vet them on that. And on the enforcement side, it's the whole character that has changed and your clients haven't caught up yet. So when someone hears the IRS is cracking down on crypto, they picture an audit, they picture an agent across the table with, the old school shoebox full of receipts, and they kind of go through that mental dread. So explain to the client that's not what it is and reframe it to them. Nothing I hate more than fear mongering on the CPA side. So just try to talk them down. As mentioned earlier, it's nothing but a computer looking at the 2 numbers. 1099 DA says one thing, their 1040 is going to say another. The system's going to flag that gap, auto-generate a letter, send it to your client. Not going to start with an audit. It's going to send a soft notice. If they don't respond to it, a notice of deficiency. If they don't respond to that, of course, it's going to trigger an audit. So the entire defense is the thing we've spent this past 40 minutes building. Completeness and accuracy documented. Accuracy is not enough. You need to report every single transaction on that form 8949. It could be 100 pages. So the best audit defense in a return is data that agrees with what the IRS is holding. And you could overcome that discrepancy with box B on the 8949. So wrapping up here, going away from this lesson, just remember these 5 things. The first is that the 1099 reports proceeds now. Next year, they're going to report the basis. 2, no form does not equal no tax. So DeFi, decentralized exchanges, that still counts. They just don't generate the paperwork. Third thing, most bases will be blank because they're non-covered assets. That's by design. That's not an error. And 4, never copy the form onto the return. Always do the work to actually reconcile it against the complete records first, because the 8949 is the source of truth. 1099 DA is what the IRS has in their hands. Final and 5th one, when the basis is blank, report your own figure in the basis not reported section of the 8949. Save code B for the day a broker reports a wrong basis. So by and large, you get those 5 right, and you'll be handling 1099 better than the vast majority of preparers touching crypto. And it's not a low bar to clear, but clearing it is very valuable, especially as crypto becomes more mainstream. People don't want to use 2 CPAs. So add that to your repertoire. It'll help with client retention and the acquisition of new clients. Because as it sits today, it's an absolute specialty, and firms exist just to do the reconciliation. They're not even CPAs. So I view it as an opportunity for the industry to jump in, grow their book, retain more clients. So that being said, that's 1099 DA, and thank you for your attention. So if you guys have any questions from here, feel free to reach out to me on LinkedIn. I'm very active there. And I also have my email displayed on the screen. So any questions, I'm happy to field them. Otherwise, I'll give you the time back.